Great, thanks everyone. Round of applause again for Elijah and EMAK and the Credence team for putting this together. A little bit louder. I think they've done a pretty good job, eh? Yeah? I think this is one of the most packed houses. I'm sorry that we're playing musical chairs a little bit. There's more folks here than chairs, but I think that's a good turnout, right? I'm also very excited to see a lot of new faces that might not engage every single day with EVs, and what that means is that I think we're growing in relevance, we're growing in outreach and getting more folks involved, and that's exactly what the sector needs. So especially to those of you that don't spend every moment of your day working on electric vehicles, thank you for being here and for listening and for offering your insights. My name is Dustin Kahler. Almost. Kahler is very close. I think that's what it was. That's probably the way it was properly pronounced in Germany before my family emigrated to the US, and it was bastardized upon entering in the border. So anyway, my name is Dustin Kahler. I'm going to be a bit provocative today because I'm not employed by anybody, so I can say whatever I want without blowback to my employer. I'm self-employed. I'm a consultant and advisor right now in the space and assistant secretary of EMAK. My background is in asset finance, having run the MCOPA asset finance business here, the global credit book and the EV subsidiary of MCOPA for a few years, and have a background in renewable energy project finance before that, et cetera. And so I'll try to take those learnings in, but with an open mind and hearing all of your insights. It's not true that I have a small panel here, because what you guys all don't realize is that you're all on the panel as well. So I would really genuinely appreciate, we have such diversity of perspectives here. And so forgive me if I call you out individually, by name, by sector, and please be proactive, offer the thoughts. I think this is a safe space here. There's a lot of knowledge here, so I want to make sure that I tap all of your perspectives where I can, please. So this segment is on private sector pathways, and I'll just I'll allow my panelists to introduce themselves first, but we're talking about how do we leverage more private sector capital into the EV space? How do we lower that cost of capital, right? You know, again, I think we have a lot of folks in the room. My first panelist I'll ask to speak is Gift, coming from the Nairobi Stock Exchange. He's a capital markets expert. I think you've been at NSE for about 2.5 years, is that fair to say? But long history before that. So Gift, maybe you can tell us a little bit about yourself and about what your group at NSE does and kind of how you're starting to think about the EV space to start us off.
Good afternoon. I think it's afternoon now. Good afternoon, everyone. First of all, it's a pleasure to be here. I think we've hosted EMAK at the exchange before, and a few familiar faces, so it's a great pleasure to be with you here this afternoon. So my name is Gift Kori. I'm the advisory lead at the NSE, focusing on SME growth and structured products. And we basically, as an exchange, our role is to link capital to opportunity. And as we sit here today, I think looking at this room, there's a lot of opportunity within the e-mobility sector. Now, that being said, there's still a lot of challenges that need to be addressed. And as an exchange, I think we are very alive to these challenges, and we would like to play our role as a private markets or private capital mobilizer to ensure that then we create or build that infrastructure that will allow capital to flow from the private sector into the e-mobility industry. Just a little bit about the NSE. I think we are always, more often than not, we are in the news for all the wrong reasons. But if you have been following us lately, I think we are the best performing market in Africa for the past 2 years on a dollar return basis. And I would really encourage every one of you to pay attention and to take advantage of the opportunities that are currently available in the market. But I sit here wearing a fundraising hat, so we want to talk about access to capital as opposed to the investment opportunities. Thanks.
Great, thanks Gift, and welcome. Quick round of applause for Gift, thanks. Yeah. Great. So Marumbo, tell us a little bit about yourself. I know you're a Pan-African man, well-traveled on the continent, and now with KABISA, which is a diversified business model, but you have a background in software and business development, foundation work, as I understand. So tell me a little bit about yourself and KABISA.
Thanks. First of all, thank you to EMAK for putting this together and everyone that's here. This actually only happens if people come and people are here for us to drive this thing forward. So a big shout out to them and yourselves. My name is Marumbo, Marumbo Sichinga. Every time I say that in Kenya, people are like, that's a weird name, because they can't really place me where I'm from. But I'm from Busia. I'm from Malawi. I moved from Malawi, spent some time in Rwanda. And in Rwanda, I joined KABISA Electric, and now we started off in Rwanda building out the business there for the past 3 years, and now we're slowly being humbled by the Kenyan market. Mm-hmm. As we learn that Kenya
Go to Nigeria.
I'm scared of Nigeria. We've looked at Nigeria and Ivory Coast recently as well. We started off in Rwanda. We are slowly entering the Kenyan market and trying to learn the lessons that we can and trying to grow out this business. We have 3 main verticals. We sell electric vehicles, we provide charging, and we do maintenance. And then on top of this, there's a layer of data. So we collect data and try to make sense of that information to help with policy, to help with financing, to help with connection. And that's what we do. Our sort of next big goal, big challenge is we're trying to build an EV highway, so putting up electric charging stations from Mombasa to Kigali. We've driven prime movers along corridors, so trade corridors. So we've driven along the central corridor, which is from Dar es Salaam into Kigali with a prime mover that was electric, 30-ton truck. We've driven a pickup up from Kigali to Nairobi several times, and now we're part of also the group that's going up to Addis for the Africa E-Mobility Week, and we're keenly looking at the corridor to figure out how we can have infrastructure, financing come into the space for this trade corridors and the EV space. In a nutshell, that's what we do. And you said everything else about me, so thanks.
Great, thanks. Let's welcome Marumbo. Great. So let me offer a few kind of structures for the conversation. The way I see it, and maybe you guys all see it differently, right? But I see in the EV space 4 major kind of buckets of capital structures that are needed, right? So 1 is corporate equity, 2, all kinds of corporate debt, working capital, receivables, financing facilities, inventory finance, on balance sheet largely. Infrastructure finance, that could be sort of project finance around charging infrastructure, maybe battery finance facilities, sort of asset finance structures, right? But where you're predominantly financing a cash flow over a number of years as opposed to a company or a customer, And then last would be consumer finance or end user finance, right? And there's obviously businesses, fleets, and individuals here, right? So the way I'm thinking about this as I ask my questions are those kind of buckets. And maybe I've forgotten 1 or 2 or I'm oversimplifying some of these structures, but a number of the questions that I'll ask here will kind of fall into that structure. I think I want to talk a little bit about the challenges that companies are facing, that consumers are facing in accessing financing for an often higher CapEx asset. We'll talk about cost of capital, we'll talk about risks, and I genuinely want to hear from the financial institutions, what are you afraid of, right? What do you need to cover off for your credit committees to get across the line to actually enter this space? What ecosystem builders need to come in and help to mitigate those kind of risks, And then I want to talk about some structures like risk-sharing facilities and the role of government as well. So I just want to paint a picture of the way I hope the next hour will go. Now I'll start with Marumbo. What kind of capital does KABISA raise from what kind of institutions, equity, debt, project debt? You have different businesses, right? You've got the cars, you've got the vehicles, you've got the charging infrastructure. Tell me about how you finance the business and maybe some of the lessons learned and challenges you've faced so far.
Thanks for the question. So we're a startup, so predominantly the financing has been from the founders and their own funds. I'm hoping all of it was legal. And then over time, we've raised through safes and raised through other partners. And then now we're doing our first sort of round of raising as we expand into East Africa. And so that's from the business end to run operations. And then other sort of financing that we've had over time has been infrastructure projects. So in Rwanda, we've been able to get some grants, so a bit of blended financing there through government funds and some debt to be able to put up infrastructure for charging. And currently we're controlling about 85% of the charging there in Rwanda. But that's only possible because of that infrastructure funding that we've had over time. And then customer facing, typically we work with banks in Rwanda, but also leasing companies. We try to focus on the things that we can do well, which for us is providing vehicles that we think would work in the market, that we're able to service and maintain and provide charging for. And then financing, we feel, is another line of business that other people are better suited at doing. And so we try to give that over to other entities that are better suited than us to do. So we don't currently internally finance or lease any vehicles. We try to do that with other partners. But we still think that there's a business there that people can do. It's just that we don't focus on it.
What are the interest rates and terms in Rwanda versus Kenya for your customers that buy your vehicles?
So in Rwanda, I need to preface all my answers so that I don't get in trouble. I'm Malawian.
What's the interest rate in Malawi also?
Let's start there, yeah. I am from Malawi, so I have no vested interest in any country. I am here to do business and live amicably with the people of the country. In Malawi, the inflation rate currently is at around 54% inflation rate. So you can imagine where the bank rate would sit, just purely based off the inflation rate in Malawi. In Rwanda, if you're buying a vehicle from the bank, your bank loan would be typically between 16 to 18% on a vehicle, roughly there in reality. But you can also access EV financing that will land you at about 10 to 12%. And that's purely because of government will and funds being available specifically for the e-mobility space. In Kenya, on paper, it's about 16, 18. In reality, maybe 24. I could be wrong, give or take. And so that gap really makes a huge difference. And then the other thing that I've found, and you will excuse my ignorance, I think there's a cost of doing business in Kenya that's not accounted for because of how lethargic some of the processes are. And so in Rwanda, for me to get certain papers or meet somebody takes me a day or two, or an online portal application. Whilst here, for me to get some certain paper information, it might take me up to 6 weeks. And there's a cost of me not getting that paper in 6 weeks that I think is not always accounted into how we run our businesses.
Anybody else had that experience? Yeah? Okay.
Yeah. And so if I'm looking to start a business and on paper, you tell me I can get something in 2 days, I've budgeted for that 2 days, right? But if it takes me 6 to 8 weeks, I have to pay staff, I have to pay my electricity bills, and that cost, I have to trickle that cost down to the end user at some point. So somebody pays for it. And it can't be me and it can't be the investors. And so you find, that's why I'm saying on paper it could be 18 to 24%, but in reality, the cost of actually accessing the vehicle could be potentially higher.
Thanks, very, very insightful. Now, Gift, you heard, first of all, where are your equity investors from? Are they from Rwanda, from Kenya, from outside of Africa?
I am not at liberty to disclose.
Okay. Now, Gift is going to tell us how we can raise more capital locally, right? So tell me, realistically, right, dumb it down for me, in the EV space, for startups, what can I really access in terms of capital, right? Because I don't see a lot of local investors in Kenya just screaming down, I want to buy bonds in KABISA, right? So tell me what you're working on, what's your actual exposure, and what are the opportunities that you're seeing for the EV space in the capital markets in Kenya?
First, let me say that the NSC is not government, and that's on a very light note. We are totally a private-owned company. So I think breaking it down into the 3 categories that you've mentioned, I'll start with equity. I think what we need to appreciate first is that the e-mobility industry in Kenya is still very nascent. There's still a lot of trial and error. Everybody's trying to see where they want to play within the value chain. We have guys who are focused on infrastructure, the other guys who are focused on the 2-wheelers, 3-wheelers, and all these people require different types of financing. But from an equity perspective, I think it's important to note that for a business that's still starting out, that is very capital intensive, it requires you to access very cheap and patient capital that will allow you to grow slowly, unlock growth, and then be able to return to break even and return the investment to your shareholders. So what we do at the Nairobi Securities Exchange is we provide access to a broader investor base, in the sense that we, through the capital raising products that we offer on the equity side, which is by listing your company on the exchange, you're able to then mobilize equity from institutional investors, high net worth individuals, and even retail investors. In the previous panel, we spoke about the different pockets of liquidity in the market, and we said that a lot of money is sitting in SACCOs, for example. But if you take it a step further, there's a lot of money that is also sitting within chamas. I think everybody here is in one form of chama, whether you're raising money for a funeral or for a project back at home. But there's a lot of money in chamas, SACCOs. Kenyans have also packed a lot of money in government T-bills and bonds. So there's a lot of liquidity in the market. The pension fund industry is growing almost tenfold year on year. I think we are currently sitting on pension assets of about 2.3 trillion, and all of that money is parked in government bonds, sadly. Now, we need to find ways in which we can be able to unlock that capital to flow to the private sector. And one of the ways is by coming to the market and raising equity. The beauty about the market is that then it diversifies your investor pool, and in a very short span, you're able to raise a significant amount of capital. Now, this is patient capital that does not require you to put down collateral. It's equity in the business. So basically, it gives you a very long runway for you to put the investment into infrastructure, start collecting from your customers, and be able to eventually break even and return basically generate a return on the investment. So that process is very simple. I think we have a new regulation that really supports industries such as yourself to come and list your companies on the exchange, offer equity to the public, and be able to raise cheap and long-term capital. I think we currently have two market segments. We have the SME market segment, and we have a main investment market segment. So the SME market segment is has really lowered the barriers to entry for SMEs that want to come and access capital through the exchange. You need, I think, 7 independent shareholders. You need ordinary share capital of 10 million shillings, which a lot of the players in the room here already have. And that then unlocks many opportunities for capital raising. If you look at the debt side, we have corporate bonds. So he talked about the interest rates in Kenya right now. You'd be lucky to borrow at 16, 17%, depending on how risky you are as a business. And as he said, there is MFIs and other credit providers who will go up to 5% monthly, and that if you look at that, the cost of capital is quite high. But if you look at the interest rates on, for example, T-bills in Kenya right now, the T-bills actually dropped to below 8% for the first time in about 6-7 years, which then means that even though the banks have not adjusted their interest rates, businesses can actually come to the market and issue corporate bonds. These are short-term debt instruments that then can be priced on using the T-bill benchmark. So that would be, for example, if Arkwright came to market and said, we want to issue a corporate bond for 2-3 years to finance our vehicles, then that means that it would be priced at T-bill at a plus a premium of, say, maybe 2-3%, which effectively puts you at around 12-13%, which is significantly cheaper than what you would be able to access through the banks. So those are alternative ways that guys can actually leverage on through the capital markets to come and raise cheap and patient capital that will sustain growth even as they figure out the customers and the other infrastructure nuances of the EV industry.
Very useful. So just to make this tangible for some of the companies, again, a lot of startups in the room, right? Like what kind of ticket size is required for either an equity offering or a green bond offering, right? And what are some of the minimum requirements that companies would have to meet? And is there really a market in the retail market among pension funds? Like if you know, a $10 million revenue EV company here comes to market, Kenya-based, meets those requirements on shareholders, like, is there really enough appetite? What do they have to do to actually get there? And I'll follow on and say, are you actively structuring any deals right now with any EV companies?
Yeah. So yes. So to answer your question, I think there's a lot of market. There's a lot of appetite in the market. Like as I said, we have a new strategy, 2025 to 2029, that is really focused on unlocking the retail market in Kenya. We believe that there's significant pools of capital there within the retail market that need to be unlocked, but those pools of funds cannot be unlocked without the right instruments coming to market. So we are actively spearheading or championing a strategy that will look to unlock retail participation in our markets. And just to give you an example, last year, toward the end of last year, Housing Finance, which is one of the local banks in Kenya, just did a rights issue. And that's on the back of the CBK requirements on core capital, which were increased from, I think, 3 billion to about 10 billion Kenya shillings. They embarked on an institutional investor sort of approach to unlock, to bring in capital. And that failed very quickly, which also tells you how risk averse our local pension industry is. However, so they changed strategy very quickly and went down local to the mashinani and started speaking to the mamambogas and the people who actually hold their shares in the retail market segment. And in a span of 3 months, they had raised 6.5 billion Kenya shillings. The issuance was 138% oversubscribed. And that's the appetite that we are seeing in the market. Now, on ticket sizes, I think the SME market segment allows companies to raise a minimum of 20 million Kenya shillings up to a maximum of 400 million Kenya shillings. The only thing, some of the disclosures requirements would include you need to have the right governance structure. Remember, we said this is disclosure-based financing. It's not collateral-based financing. So it's by and large unsecured. And therefore, then the right governance structures need to be in place. So we would need to see good board of directors, very qualified senior management, and then we would also want to see your audited financials, which need to only be 1 year. You only need to have 1 year audited financials in order to issue equity. And then we would want to see a very solid business strategy that will support a return on your potential for your potential investors. So I think those are the broad requirements from an equity perspective. On the other side of debt, I think it would be mainly what we'll be looking at is the strength of your balance sheet. What are you holding in terms of assets, and what level of debt can you absorb? But on the main market segment, you can raise, of course, a minimum of 400 million, and the ceiling is based on the equity in your business, meaning that you can leverage up to 4 times your equity for any capital raise. So if you're a $10 million revenue business with equity of, let's say, $3 million, you can unlock up to $12 million in terms of debt, as long as your cash flows can support the debt repayments. And I think maybe just to finish on that point, if you look at the way debt is structured in our markets, it allows for you to really plan your cash flows out very well, because you're only required to pay the principal upon maturity. So what you're servicing in the meantime is interest payments, which are paid semi-annually, which allows you to actually absorb the money into your company, bring in those batteries from China, sell them to your customers, start collecting cash flows, and then prepare for the bullet payment that will be needed at the end of the facility. And there's still an option to refinance that corporate bond as and when it matures. So I think it provides for a very amenable way to manage your cash flows over a long period of time.
Before we go to the other panelists in the audience, get ready. Just to follow on, would you do an asset-backed deal? So say, would you finance a network of batteries without any sort of guarantee from a corporate or an SME?
It's interesting you say that, because as I was seated there, I was actually going to say that the ABSs, asset-backed securities, are a very sort of good way for for this industry to look at, because somebody in the previous panel spoke about leases. I think you could securitize the lease rentals and issue that as debt on the market, which frees up your cash flows and allows you to deploy that more. We just issued an asset-backed security this year to build the Talanta Stadium. That was a 44 billion Kenya shilling ABS. So yes, there's appetite in the market, and I think I think the future is structured finance products. If we cannot find clever ways to finance nascent industries such as this, then I think most of the people, all of the players, will die in maybe the first or 2 years. So I'm actually speaking to a couple of guys within that sector. We're trying to look at instruments such as green bonds, which sit very squarely within the industry. We are looking to see how we can unlock trading of carbon credits that can be generated, and see how we can securitize those as well and form that as part of the financing that can flow towards the sector.
Right. So hopefully, I think pretty insightful. I think at least I myself don't think of the Nairobi Securities Exchange as my first kind of port of call when I'm going to raise debt, and maybe I should be, right? So I think what we want to try to create here is an understanding of the diversity of the ecosystem, right? So I'll certainly ask folks from the soccer world to stand up and talk a little bit about the way you see the industry. Hopefully there's some folks in the banking sector that we can kind of share some insights as well, but this is just one pool of capital we can look at. Going back to painting a picture, and again, I'll talk about this in broad strokes, right? We talk about the cost of capital here in Kenya, right? Forgive me if the central bankers are here in the room, but the central policy rate right now is at 9.5%, down from over 12.5% a year ago. And we're talking about, bank loans in the 17 to 20-ish% range often. Obviously, there's risk premiums for different sizes of business and kind of risk. And we could talk about, hey, look, first of all, it's good to see that coming down a bit. It's good to see treasuries coming down, and that reduces cost of capital. Obviously, we've been in an environment where interest rates in the U.S. were high, and that was kind of stealing a bunch of capital, increasing the cost of capital in other markets as well. When you look at markets where the EV industry is growing very quickly, interest rates are quite low in Southeast Asia and South Asia, right? So India, central policy rate is 5.5%, bank loans often at 9.5%, Vietnam 6.5% policy rate, roughly, bank loans also sub 10%. But you heard about Malawi. Nigeria, anyone know what the central policy rate in Nigeria is right now? 27%, right? Even there, you can get some interest rates at kind of 36%, 35%, but you can see there's not a lot of spread in there in the risk, right, for financial institutions. Obviously, very difficult in inflationary environments. Even Brazil, pretty developed market, 15% central policy rate, bank loans 25, even up to 60%, depending on the kind of the risk premium, right? So what I want to paint is that we have a high cost of capital in Kenya. It's coming down, but we're not alone, right? There's plenty of other emerging markets, middle income markets that are financing EVs and making this happen. So I think saying that this is a problem is true, but saying that there are not solutions out there is limiting, right? Now, we talk about some of those interest rates there in the banks. We talked about capital markets. The reality on the ground is most of the EVs in Kenya are financed by asset finance companies, right? These are digital fintechs, MFIs, right? In the two-wheeler space, it's folks like Watu and Mkopa. We know that the banks and the MFIs are a little bit more involved in the four-wheeler space. If you look at the actual cost of capital being paid by the boda rider, right? We're talking about In the ICE space, we were talking about 60% APR, 70% APR. EV interest rates from the asset finance companies are generally lower. Correct me if I'm wrong, Steve, but we're talking in the 30 to 45% range, right? I think that prices in an eagerness to try EVs. It's probably a little bit of an experimental interest rate, but also reflects some lower risk profile potentially due to the increased cash flow. We know that generally 30% net income increase from EVs, whether it's a high utilization four-wheeler, whether it's a boda, a delivery rider, even in the freight space, right? Because of the reduced fuel expenditure. And there's a higher CapEx of these assets, but if it is financed at the right terms, right, we are genuinely seeing day one savings across the space. Now, there are a lot of other risks, right? There's a new asset class, and I want to hear from the financiers in the room about what you see. But when we are talking about the asset financing that's happening, right, we can complain about a very high interest rate, and there's a lot of publicity about their kind of criticizing asset financing interest rates. But when you really dig into it, asset finance companies are raising money at 17%, right? Then they might have 10 to 20% defaults, right? If you're going out into Mashinani, right? You've got, you know, on top of the product costs, you've got VAT, import duties, et cetera. You're looking at, when you look at a 30 to 40% cost of capital, it's tough to see how those institutions, to be frank, are actually making a lot of money, right? When they're borrowing at 15 to 20%, they genuinely have 15% defaults at least. In the ICE space, we were talking about 25% repossession rates, right? I can say those repossession rates are lower in the EV space because you can track an asset much more easily. And especially with swapping and other types of risk mitigates, you know where this customer is, right? So one of the interesting things about EVs is again, the cost savings, the telematics, the technology that provides lower risk mitigation, even for more risky consumer finance segments. On the other side, you got a new asset class, and I understand some trepidation about what's the longevity of these assets, how are they going to be maintained. Most of the companies in this space are not Bajaj and TVS that have huge balance sheets and huge track records, right? One of the challenges that I see that I'll be a little bit controversial on is a lot of the capital coming in to the space and the startups here, these are high cost of capital startups and financial institutions. You're not seeing at the table at scale the lowest cost of capital players, right? So the big oil marketers, Vivos, Jeff, I see you're in the room. You have a low cost of capital, right? The banks in the room, you guys have a lower cost of capital. But most of the folks that are financing, the folks on the ground, are startups or fintechs with a higher cost of capital. So what I'm curious about pursuing here is let's talk first with the startups and the OEMs in the room, right? And understand like what are the challenges that you're facing at accessing capital, right? And when I say it, I mean quantity and I mean cost. So let me ask for a little bit of exercise in the room. I'm very curious to understand how many folks here feel like you're from the EV sector, an OEM, a distributor, a swapping company. Can I get a show of hands? Yeah, let's just see how many folks are pushing product out into the market. Raise them higher if you can. Okay? 20, 30% of the market. Okay? How many folks here are from the finance sector? Banks, MFIs, SACOs, capital markets, insurance. Okay? Another maybe 25, 30%. And now how about ecosystem builders and support? So if you're from an NGO, a foundation, DFI. Okay. And hello to anybody that I forgot that's not in one of those categories. Yeah? I want to hear the pain of the actual sector. So we talked about KABISA a little bit, right? Who can share me? Let's go around and get a few anecdotes, right? I'll bring the microphone around. Tell me, what are the main challenges? Is it raising equity? Is it raising project debt? Is it raising working capital? And what are you hearing? Whether it's from the banks, the SACOs, the fintechs, what is the pain in your side? What is preventing you from growing? Who can offer a few insights? Joe from ArcRide, thank you. Okay, great. Yep.
Hi guys, yeah, Dustin did tell me during the coffee break he was going to ask this question. So we publicly announced last week a 10 million debt raise from Marumbo. Marumbo is a French fund, Gigaton Fund, one of the largest climate funds in Europe. And it's very, very difficult process. I'm not gonna lie. It's like, it might be a European funding institution, but it's a bit like dealing with a local bank. You know, when we're talking about a senior secured product, I'm lucky I've got this jacket. I got rid of the trousers, but the jacket's still here. No, but what I'm really saying is that as a early stage founder with higher costs of capital, you have to put everything on the table to get to the next stage, particularly within the debt. This idea that you can not risk your entire senior secured position, I think is impossible. And that took me a while personally to come to that understanding. But if you want to have that real growth capital amounts of money, you have to go all in. There's not a case of we're going to go poly on this. I want to be able to secure the asset infrastructure that we've built. If you think about the infrastructure we've built, we've got over 5,000 charging points in Nairobi already before they even put a penny in, right? So we've really raised equity. We've put the money on the ground. We've got the bikes. For those that don't know, you've probably seen a lot of the yellow Uber bikes, which are arc ride bikes. We've really got this revenue coming in. But what's interesting, so that's the sort of the debt story. But on the equity story, I think the really sad truth is that it's still a competition. We haven't got to that point where the DFIs, the big funders that can take this to the next level, are willing just to back the sector as a whole. Most of my equity conversations, I'm sure some of the other companies would also, if they're honest about this, you're in a competition rather than there being enough money to fund the whole sector, which is what's needed. Because really, you know, when we come back to the founding of EMAK, and look how big it's grown. Congrats to everyone for being part of this ecosystem. Originally, it was like 3 or 4 companies saying, hey, we want to do e-mobility. Now we've got like a whole ecosystem coming about, but the funders are still seeing us as competing rather than how do we come together. And actually there needs to be big structured funds that enable maybe some first loss capacity coming in and then structured equity finance coming in behind that at scale. So it's like, say, a 200 million equity fund for e-mobility funded by different DFIs, and different people can apply for that and take chunks as these things don't exist. So instead it's a complete gunfight basically, and everyone's trying to climb on top of everyone. It's not really an enabling capital environment. And I think that's a huge challenge.
Joe, let me ask a follow-on. So Joe's company, ArcRide, is a battery swapping company in the two-wheeler space, right? So they have to finance their network of batteries, which is owned by the company.
Yep.
And then there's consumer finance where they offload the assets onto customers, right? So tell me, Joe, like how, those two buckets, right now, who is financing those two buckets, right? Or what's their go-to-market channel for those? So on the bikes, who's your offtake there? How are they financing? And on the battery, how are you doing that?
Yeah, so the financing, we don't do any direct financing to the customer. So it's the Watus, it's the Mogos, it's the Green Wheels that are financing the end customer. That's driven primarily through 2 stars funding for us. We have equity investors. We're lucky enough to have some strategic equity investors. A large Japanese company called Musashi is our major OEM backer. And getting that company on early was so important for us because it was that early stage risk capital, long-term growth, focus on building a product. Without that equity investment, we would have never got to the point where we could have enough inventory to sort of grow. And it really had to grow. The first sort of iteration of ArcRide was purely equity driven. We couldn't get any debt until we had quite a lot of traction. So that's the second bucket. We then have inventory finance for the short-term financing on the vehicles. And then the Marumbo facility is the first time we've really created a long-term battery asset-backed securitization structure, but we've had to put the whole company on as well as a senior secured product to make it viable.
Okay, so it's asset finance for batteries, but it's actually you give away your life in exchange.
Correct.
Okay. Let me go to, I see there's some folks from the Ridewell team here. So Joe's company is kind of a lot of foreign funded equity from around the world, right? If I can call you out, we have a local company that's also doing two-wheeler EV financing. I'm curious about what's your experience distributing and what are you hearing from the market in terms of financing for consumer finance potentially, if you wouldn't mind sharing.
There's been a significant transition over the last 2 years where I think someone in one of the earlier sessions talked about the lack of familiarity with the product and the lack of understanding to now where the consumer who's buying the product is very sophisticated, has begun to understand the comparatives. There's a lot of understanding about the range of the bikes, the technical specs of the bikes. and are increasingly looking for competitive options to be able to finance these. A number of them are even increasing their own fleets substantially. So I think there's generally a much better understanding, and it's beginning to spread beyond Nairobi quite significantly. At the end of the day, I think it all comes down to affordable financing, whether it's for the companies, whether it's for the end consumer, whether it's the option suggested by the gentleman there regarding the NSE as being a route to raise capital. I think that's really, to me, the most important piece in all of this today, in terms of letting the industry grow and being able to expand the industry across Kenya significantly within the next 2 to 3 years.
Thanks. So again, Talib has a distribution company for EVs, right? Now, what are you saying, Talib? Like, are the banks interested? Are you gaining traction? What are you hearing from them? What are their terms generally, without giving away your special sauce? And what are the risks that they talk about when you bang on the door? Like, what are they afraid of, right? And then we're going to ask the banks here to answer the same question.
My experience with the banks is that they're dipping their toes in the water now. They're not yet convinced. They're managing the risks very carefully. But there is a sense amongst some of the larger banks of creating a unique space and supporting the industry. I think as the conversation spreads across the country and the leadership encourages this sector, more and more banks are getting involved. I know of 1 or 2 OEMs that have built significant partnerships with the banks and are breaking the ice. But I think it's a slow process. And I think as they gain familiarity, as they understand the full life cycle of a bike, I think more and more players will get involved. But it's a very gradual process, and perhaps EMAK and such organizations can clear the understanding for some of these banks so that more can participate. Because I think, as we said, they have the scale and they have the ability to risk some capital towards this sector.
Thanks, Talib, for sharing your experience. We talked a little bit about the two-wheeler side. I wonder, Moses, are you in the room at all? Or somebody can speak to the bus space. Anybody? Yeah? So my question, you can introduce yourself. What are the challenges that you're seeing in the bus spaces? Are you using public finance? Are you using banks, et cetera? And who's financing? What kind of innovations have you had to come up with to make this work? Thanks.
All right, thank you. Once again, I'm Joseph, Managing Director for ICM, Intercorridor Mobility. What we have come to experience, as I said earlier, we have gone to almost 6 banks with no success. And I say that I'm discussing this from a consumer and also a provider part of it.
Remind me what you're selling. What are you trying to finance? What's the asset exactly?
The buses.
Okay.
We are the so-called matatu industry in Nairobi and across the other big cities. There's a company called Basigo, there is Rome, who have tried to really lease the buses. But once you understand that this product is better than the diesel engines, you want it more. So those companies have now fallen short of supply. And I think most of us now we are coming up to ensure that we are in the market as well, because we are the players, we are the consumers, we have the route licenses from the government. We want as many buses as possible because 2 things have come up. The operational cost for an EV bus is down by 40%, which translates to a lot of money. And number 2, a good thing about it, which the banks have not come to understand, that our electric buses are predominantly cashless. So revenue comes every minute, repayment of the debt is every minute. So you can just structure from your app that this money comes, it is paid, this amount, this percentage goes to the bank immediately. You can do that. But now when we explain that to the banks, they still don't understand it. They think about the industry as the old financing models, like they do with the Isuzu, the truck conversion by Isuzu. But what we have come to try to advise them is that our industry is a very liquid industry. Money comes every minute, so your debt can be paid every minute, but they still find it as a big risk. We even, actually, my colleagues are here. I think they are here with me, members of the board. Can you rise? Have another lady there who is our administrator.
Welcome.
We even try to give them a challenge. You go to every yard for repossession of the buses. A matatu will never stay there for 2 weeks. But if you finance a pickup and you repossess it, you can stay with the yard even up to 6 months without somebody coming for it. Because a matatu is always required to be on the road. And passengers are boarding and alighting every minute, every second. So if we can have a structured financing for that sector to look into, we are the one who are taking up. Before the government felt, if we push the EV buses into the matatu sector, the matatu players will rebel against it because there was a perception that they are being pushed out of business. But now the industry itself has come up, invested in it, and they want to take up the market. ICM, we are looking at, in the next 3 years, if we get good partners and equity, at least 25% of all the buses on the Nairobi streets to be EVs. And we have tried to convince that to the banks. They still don't find it a problem because their issue is with the charging infrastructure. They are always asking, once we finance you this bus, you need to keep it on the road. Where will you be charging? We can't see where you charge it. So we are trying to work with the government, the county government, for the EMAK depots for the government so that we can do partnership through that and establish our charging station because the buses charge at night. You can have a depot that is charging even at 30 buses on one corridor. The other corridor, another 30 buses. If the banks can accept that, finance the charging infrastructure, or those companies who are doing charging, they partner with public transport companies. We give you the land, you build charging stations for us. Because our buses are guaranteed clients to that charging station. We will charge there every day between 10 p.m. and 4 a.m. You have a controlled business on that, but still the financials can't feel it. I don't know why they are skeptical a bit about the public transport, but whatever Basigo has done, it has also convinced so many people, even in our sector, it is even safer to invest in a bus, an electric bus, than going to Isuzu and get a diesel engine. Yes.
Thanks a lot.
Something else also on that. You look at, right now, the Basigo are doing assembly at KVM. So we, as ICM, in part of our vision and our project, we are looking to establishing also a locally owned assembly plant for the buses. Because at the rate at which the taxes are to bring in the whole complete bus, it's too expensive, around 65% taxes. But if we can do an assembly plant in Kenya for the buses and other small products that associate with that and service stations, you will realize within 2 years, this discussion will be completely different. There has been too much emphasis on the two-wheelers, which is a good thing, it's a good business. But I think they missed the point. The main business is in the buses. Because the buses will also influence the SUVs and the vans and all those. It is the buses that will now create that information in the people. If I can board, like if you go to town today, you will see a queue longer for the EV buses than the other buses. Why? There's a lot of comfort and safety. So if we can focus a bit on the buses right now, for charging and supply for the buses and also the assembly, I think within 2 years, this discussion by EMAK will be different. Thank you.
Very insightful. You have something to add? Yeah. Okay. Thanks. I think, let's see you hear a question. Good. I like more dialogue. Here you go. Please introduce yourself as well.
Thank you. Actually, mine is not a question, but a response to what Joseph has just said. My name is Faith from Equity Bank, and maybe I want to defend the banks a little bit. We are aware of those challenges, and there are so many factors that banks are looking at for them to be a little bit hesitant into lending into e-mobility. For example, if we had to lend to either you as an e-bus and the other usual kind of a bus, for you, I'll be giving you about 20 million. For the other bus, it's about 8 million or so. Yes, so it's like you're 3 times higher than the usual bus. Yet when they're at the road, you're charging fares at the same amount. We don't have any special fare for the e-mobility. The amount of bus fare that a client will pay to the usual buses is the same amount of fare that they will pay to. So there's no extra income that you're getting just because it's an e-mobility. So this now is a solution that can only be solved probably by the government. If they can bring incentives to you so that maybe you can lower your capex whenever you're getting these buses, then at that point the banks would feel, because I'll feel as me when I fund or when I let to the usual bus, within 1 year it will be they'll have broken whatever, I'll have gotten back my money. But when I let to the e-vehicle, I'll have to wait for like 15 years or so for me to get back my money. So you see, the risk is quite higher compared to the usual fossil fuel, whatever. So the solution lies with our policymakers, with the government, to make your capital a bit lower. Thank you.
I have to say, I've had numerous conversations with Equity Bank, with KCB, NCBA, et cetera. So I have agreed that their banks are looking, yeah? And clearly you've looked at this as well. So just to clarify, now it's your turn. Bankers, SACCOs in the room. This is not bank bashing. You have a high cost of capital too, by the way. I'm not suggesting that you're overcharging. But I think I'm going to answer the question in the same way as you are. Let me try. Revenue, let's assume that the revenue is the same and the ticket prices are the same. I think what is missing in this story is net income, right? Because EVs generally 30 to 40% net income increase for the operator, whether that's a boat rider or whether that's a bus operator, yeah? And your repayments as a bank come from net income, not from revenue, yeah? So let's think through that. It's about the whole story, and maybe that story is not coming out as well as it could, right? Now let's discount that 30 to 40% because maybe we're afraid of operations and maintenance and some battery risk. Okay, I think that's where we need to get to, right? Let's say there should be a relatively higher ability to pay back an EV loan, a relatively higher capex, but banks like to put out more money, right? But let's think about then the risk as well, right? So I think I value your point. I think maybe let's continue to hone in on that and net income and how can we make sure we're communicating appropriately about that savings, right? I would love to hear from others in the room from the banking and SACCO sector, what opportunities and risks you are seeing as well. Is anybody here, again, I'd like from the traditional finance sector as opposed to the asset finance sector, is anyone else able to share some perspectives? Like, what are you afraid of? What are you excited about? Yeah, feel free to go ahead.
Just one point also that is supposed to be added in that conversation. I also brought in the aspect of assembly. An EV bus, the one that is costing 20 million to import, if assembled in Kenya, it is between 9 million and 12 million. It is the taxes that are a problem, not even the bus itself. So if the financiers can also invest into financing a proper assembly factory in Kenya, you unlock the entire market, both for the SUVs and the buses at almost better rate than the one that you're talking about.
Yeah.
Thank you.
Taxes are often up to 50% for some assets, right? For between VAT, duties, et cetera. Cliff, love to hear your perspective. Maybe remind us exactly what role you play in the system and what your learnings are.
Cliff Aaron, GreenMax Capital Group. Look, we have to be real about who banks are, right? I mean, and what they're there for and who they're accountable to, right? So, banks are the most risk-averse players in the whole finance ecosystem, and there's good reason for that because they're the fiduciary of your and my savings, right? So, if you want to get a bank to do anything new, no matter whether we say and we can prove that the risk is equivalent or lower, just because it's new, the perceived risk will be up here, right? So what we do at GreenMax is we have a facility called the Green for Access First Loss Facility where we partner with local FIs and we give them a 20% first loss cover. 20%, the first, on a portfolio basis, the first 20% of loss we will cover. Now, we do that confidently because we know that the losses should be, if underwriting is done properly, 5 to 10% max. So what we're doing is we're covering the delta between perceived risk and real risk. And that's what has to be done at market entry. Unfortunately, we tried to work with Equity Bank, but you decline. We tried to work with other banks. They also declined. So we started working with MFI. And we have a facility, it's not for buses, it's for two-wheelers and three-wheelers with Fortune Credit. I don't know if anyone from Fortune Credit is in the room, but we were able, with our first loss cover, to knock down their cost of lending to boater riders and tuk-tuk drivers from 36% to 21%, which I think is just about the lowest that any asset FinCo or MFI is offering on the market. We've done to date about 600 two-wheelers. Some of those are bicycles. And, we invite everyone else in the ecosystem. We're working with Rome and with EWAKA so far. We'll work with everyone and bring them into this low-cost capital from Fortune Credit. But the key is there needs to be more guarantee facilities available. And to the gentleman from NSE, there is a facility that is available to guarantee institutional lenders into this space. It's called Damana Guarantee. I don't know if anyone from Damana is here, but they're a very important player in the market because they will provide a 90% cover to local institutional investors in green bonds. So we're working with them as well. But I think the key is that delta between perceived risk and real risk. And if we pretend that it's not real by saying, well, we have the data that shows the loss, that's great, but it has to be proven over time.
Thank you for that. I think maybe just to add to that, then I think if you're looking at it from an industry-wide perspective, not just solving for one player, I think the gentleman from ARC said we need to develop funds that could specifically look at the e-mobility industry. And it's easier to actually layer on the de-risking facilities at the fund level where we have fast loss guarantees. And then those can then be distributed through MFIs and banks so that then we can reach the end user. One of the key examples is before a couple of years ago, mortgages in Kenya were literally unaffordable. I think we had about 25,000 mortgages in Kenya until KMRC came to the Nairobi Securities Exchange, of course, using a government-backed guarantee and raised 1.4 billion shillings, and which was really just to go and support issuance of mortgages. And that was a blend of both concessional funding and capital raised at about 12.5% in the market. And that then was deployed to banks, which are now offering mortgages at 9.5%. But we all know that before that, mortgages were at around 22, 23, 24%. So I think we also need, as an industry, to take an industry-wide approach and see how we can lobby government and the DFIs and the guys who have the structuring capability to come up with instruments that can solve for the entire industry as opposed to just single players in the market.
Good feedback. I think very insightful. So we're hearing that, hey, look, there's a learning process to get by design conservative financial institutions, responsible financial institutions, right, involved in the market, and the role of blended finance and guarantee facilities. And so I think some of these names are important. I know BII is in the back of the room as well. I think, Habib, do you have anything else to share about what your learnings of these like first loss facilities, or I'll come to you in just one moment. Just to keep on this first loss blended capital facilities, what lessons have we learned in engaging with financial institutions and companies that might help to cover off some risk?
Yeah, thanks, Dustin. Hi, everyone. My name is Habib, and I work at British International Investment, which is the UK government's development finance institution. And the team I work with is called the Climate Innovation Facility, which is a $300 million pool of capital that extends debt to innovative climate businesses in Africa and Asia. And e-mobility has been a big sector for us in Kenya and East Africa. And the way we think about how we deploy our capital is just being very careful about the structures that we deploy. So something that we've been able to do in the sector is take subordinated or first loss positions with our debt with the explicit goal of catalyzing senior lenders who need that sort of comfort to come into earlier stage businesses. Something that we also are able to do and have done in the sector is take local currency risk, where we can extend debt in local currency, and then if there's any devaluation, it's BII that takes the hit, not our borrower. And then finally, just being very flexible with the underlying terms of the debt, quite long-term or long grace periods, and being able to work constructively with businesses we lend to in case of any bumps in the road.
Thanks, Habib. So I think we'll close out. We're getting close to our time. I think I'll close off with kind of two thoughts. There's one gentleman that has something to say. Okay, I think we'll do two comments here, and then I want to close. We're talking about risk, and I want to challenge the Britam folks here in front to give a bit of a non-lender perspective on risk to close out, if I may, and what you're seeing and what risk mitigates we can introduce to the sector. But let's go with two final comments here. Yeah, the two gentlemen in the middle, please. Thank you.
All right. Thank you for the opportunity. Yeah, I think...
Please introduce yourself as well.
Okay, I'm Robert from Banavim, yes. And I think the question I'm having is about the financing and the period of financing. Because now you see that in most cases you want to recoup your finances maybe after, your investment after a long period of time, let's say 15, 10, maybe 20 years. And the life cycle of these, the vehicles which we are using, how long do we expect that they are going to run? Seeing that at some point we'll need to change the battery to, there's going to be an overhaul in between this, during the finance period. And in that regard, then how are we going to also ensure that these unforeseen circumstances where in case the change of the battery is going to bring a large cost to the business, how are you going to approach that?
I think just to quickly answer, it depends on the sector and the company. I can say there's certain things, for example, there's a financial institution in India that will upfront agree to specific terms to refinance your battery 5 years from now, right? So they'll underwrite a technology and offer some sort of financing for that. So there are ways to deal with that in more developed markets, I would say. And here, I think what I'm hearing from you is a real risk, right? Which is what happens at end of life on the battery. And personally, I can say I don't personally think that the companies that are, say, selling batteries to customers are dealing with that and communicating well enough what that journey looks like. And I think you could say the same thing to the way that they're communicating with the banks as well. And one way that we've dealt with that is through battery swapping or battery leasing, where the customer doesn't take that risk. But I think it's a risk that I hear about a lot is what happens to the battery after 2 years, 3 years, et cetera? What's the warranty? Sometimes the warranty is shorter than the financing term, and that's a real risk. So thank you for bringing that up. Next question or comment?
Thank you so much. So my name is Evans Ikua from Panther Mobility. We are an EV startup. And I wanted to just make a comment based on that conversation about financing and risk. And I'm very happy to hear what the NSC, the tools that the NSC has in supporting small businesses and startups. Now, based on what I have had, a few points that I've had, one from Faith from Equity Bank, and as somebody said, banks are very risk averse, and I fully understand what she's saying, because at the end of the day, when they're financing, they're going to be looking at risk and what the possible returns for them are going to be. Now, as a startup that has been trying to raise capital to get into EV, one of the biggest challenges that we've seen is that being a very, very highly risky business to get into, it's not easy to raise that financing and that capital. Then somebody talked about the cost of for instance, the buses being much, much higher than the diesel options. And then there's a conversation about reducing the cost of those buses so that they can be as close as possible to what we have with the diesel engines. But the possibility of having those EV products being brought, the cost being brought as low as possible is not going to be possible if you're going to operate like a colleague of ours here who said, right now the industry is like a gunfight. Everybody is trying to climb on top of the other. So my challenge to us as an industry, as an nascent industry that is trying to grow and bring costs down so that our products can be made affordable in the market. Maybe what we need to be thinking of is about de-risking the whole ecosystem, the whole industry, so that we can be able to figure out how to work together as an ecosystem, so that we can be able to have the different components being manufactured in Kenya. I would be very happy if I can be able to go to Basigo and buy batteries from there, go to Rome and buy a motor there, go to Akride and buy, as another component instead of importing it from outside, and then having all those components being made locally by different companies, so that we can be able to work with each other and buy from each other instead of one company trying to do everything and then ending up importing from outside the country. Because at the end of the day, that way we're able to bring the cost much lower, and generally we are all able to remain in business much longer and much more easily. Thank you.
Thanks for that comment. And then just a reminder again, if you look at like the 2- and 3-wheeler space alone, for example, there's 10 million of these vehicles coming online, almost all in Asia every year. But our African markets, we can celebrate, hey, we're making a lot of progress, growing 200-300%. We're probably looking at 10 to 15,000 vehicles here in Kenya. And so to get those costs down, we need scale, right? And so we need financing mechanisms to build the ecosystem. Competing for a small pie is a rather futile game, right? And so I think if we expect to all grow this industry together, we need that pie to grow, and that requires scale, facilitating finance for customers, and more ecosystem building approaches. So I appreciate that comment. Just again, I apologize. We're a few minutes over, and the Credence team has done a very good job of keeping us on time. But I just wanted to hear some final comments from the insurance space, because again, what do you see as a bit of an impartial, risk-based evaluator here? What do you think the industry needs in terms of what are the major risks we need to tick off to be able to achieve the scale that the gentleman just mentioned? And then we'll call it a day.
Right. Good afternoon. I'm Wanjoy Gitonga from Britam, and Britam PLC is, amongst other things, an insurance company. So we are basically involved in the business of risk transfer absorption. We fear nothing.
For a price.
Yes. We fear nothing. You bring it on. The only thing we've been fearing so far, but I can foresee a change of that fear from this emerging market of e-mobility. We don't touch PSV. We don't touch PSV. The numbers of claims are way through the roof. But the way I see those buses crawling around town silently, they don't look like they would harm anyone. Or do they silently? Now, PSV.
There's PSV folks sitting right behind you, so be careful, eh?
Yeah, yes. Now, I've had infrastructure being mentioned. I've had FADs, CAPEX, everything, but not human resource element. Companies, no company is made of brick and mortar, cash flow, furniture. It is made of people. We are there to take care of you and the people you left back at your places through our risk mitigation products, group life, group personal accident, corporate medical, group last expense. We have WIBA, the work injury. We take care of all that. Then also Keyman Insurance, don't forget it. There's some of you who've come together to be directors in a new venture where both, if you are 2 or 3 directors, your families are feeding from that company. Then one director unfortunately leaves us. I don't know whether the director who remains becomes a spouse to the widow or the widower. I don't know. We are in that space also to ensure that the family of the departed director is taken care of. Then we are also now into infrastructure centered risk mitigation products from goods in transit on land, marine, and aviation. Then also we have the fire and burglary. Now, when you look at electric, what comes into the mind of an insurer? Fire. So fire and burglary, Those batteries, I understand, they are very expensive. Zitabebwa. We have a destruction. Yeah, in Kenya, Visichivanya is not Malawi.
And any just to cover this off before the Credence team kicks me off stage. What are the two things that can help you to understand that risk and price that risk better? And then we'll.
What are they?
Not what are the products, but what information? What insurance is about accuracy of information, right?
Yes.
So what information are you lacking that you need to be able to price that better? And
I would say as of now, it's
honeybees.
Yeah, being a new emerging market, we may not be having the information we are getting today. Actually, even me, today is a learning process, such that there's someone from Siemens who asked me, what do we have for what? And I said, we need information about what do you have, then as we shall develop a product. We are dynamic every single day, that today we'll get this risk that is emerging together with the emerging industry.
Okay.
Thank you very much.
Thank you so much. So I think in conclusion, I think we all need to go take a trip to India, paid for by EMAK, I don't know. To see the 3 million EVs going on the road every year, the 5 million EVs in China that are going on the roads every year, and learn from them on how to price those risks, right? So maybe that's something for the donors in the room to treat us to. Thank you all for listening. Thank you for the extra few minutes. And thank you again to my distinguished panelists. Did you have one last thing to mention?
I just had some closing remarks.
Okay.
I think just to echo the same points, and I'll try to do it quickly, but EVs are about 1% of the whole market. And I feel like there's a sort of a sentiment that EVs are coming to take away from something. Even if you quadruple everyone in this room that's supplying EVs, we still won't be able to meet the market. And so I don't know why there's this fear for EVs. Everyone here, Basigo, Arkride, whoever, you quadruple what they're currently doing now for exit. We still won't be able to meet the market. And then we forget on top of that, that EVs are adding jobs in other industries and also making sure that our grid works, because we need a grid that works, that also has other ripple effects to the market. And so sort of fighting it for me doesn't make sense. And then another thing is like to the banks and the policymakers, like we need you guys to make this thing work. And it's just a matter of will. Like I'll give you an example in Rwanda. I have a client in Rwanda who replaced their fleet. And right now they're telling me that net zero. The cost of their fuel and maintenance is what they're spending now to pay back the bank. They're not even taking from any other extra income. They're literally at net zero and they've replaced it with 5 new vehicles. And we can do that here. There's enough cash flow in this country. There's enough, if we just have enough will and ability, like even Clifford said, to like really mitigate what is actual risk and this perceived risk. And I feel like a part of it is that we just cause things we don't understand risk. So if we don't understand it, we just call it risk, and then we add 5% and just call it risk. And so 50% according to Moses. And so my hope as somebody who's in the space, I've been coming to Kenya now over 3 years, and I've seen the needle move. So I want to applaud the effort that's been made. The needle has moved. But Rwanda is like 18 times smaller than Kenya. Purely on policy, they're able to do things that Kenya should be doing in a heartbeat. If you look at Rwanda's GDP can be summarized in Kilimani, Kilelesho, and Westlands. I'm done. I'll go back. But because they have enough political willpower and people are willing to take actual risk, and I'm not saying that there's no risk in EVs, please hear me correctly. There is risk. There is definitely risk, and that's why startups exist, to take on that risk and you make a bet and hopefully you win. But business is hard as it is. Like we shouldn't make it that much harder by putting perceived risk on things that we could be solving together. And the benefits affect all of us. Cleaner air, it's cheaper transportation, you can get cheaper cost. The actual benefits outweigh what we're perceiving as risk, is my point. And so if we work together, one as an industry, and also from policymakers and people that actually work in the space, we can make this thing grow very easily, and the benefits will be, the benefits will affect all of us. So you yapped a lot, but my goal there being that this thing is going to actually add and not take away.
Including to your bottom line.
Including to hopefully my salary as well.
Yeah. All right. One last, just to do justice for final comments from the.
Yeah, I think mine will be to challenge the entire industry. I think we are, as the Nairobi Securities Exchange, are willing and ready to support you to list an e-mobility fund, and we will crowd in all the partners from a guarantee perspective. The MANA, we have a very good working relationship with the MANA. We have very good working relationships with the DFIs in the room, BII, IFC, and all of the people that are required on the table in order to build a fund that will be able to support the entire industry. So I will leave this challenge to Elijah, and so that the next time we're having such a roundtable, we will have a fund that we can all tap into in order to grow our businesses.
Many thanks. A round of applause for our panelists and the audience and up here. Thank you very much.